just start at the beginning and work right. Yeah, good. Start at the beginning and work right through the quiz. Tired, you guys. So many people. Okay, so this is today's quiz. That's your cancer for your class.
Meeting.
Number one. Quiz today. Okay, quiz 3 and 4, spring 2016. All right. So anyway, these guys, the following transactions they occurred during the year. Received 50,000 cash from investors. Each was issued 1,000 shares of common stock. What did the company get? Yeah. 50,000 of cash. It's an asset. You have more. Debit it, right? These are gimmies, aren't they? What would you credit? It said it was common stock. I think I'd go to common stock, wouldn't you?
Yeah.
Okay. Later we'll separate par value from additional paid capital. We don't have a par on this, so that's all there was to that. Okay. So that's A. B. Purchased equipment for use in the business for 16,000. Paid 1/4 down with stock. Oh. The balance is due in 6 months, which must be a note payable. Sure. So what did the company get? Equipment. These aren't bad, are they? First problem for no confidence building. And then what? Common stock again. How much? 4,000. And notes payable. 16,000. I bet you just flew through these, huh? Okay. Also, C. Sign an agreement with a cleaning service to pay 1,000 per month for cleaning the corporate offices. Now, signing the agreement isn't a journal entry, but what about paid for 2 months in advance? Oh, that is. So what did I pay it with? Paid it with cash and bought a prepaid, right? So credit cash, I guess, and debit the asset prepaid. Why is it prepaid instead of expense? Didn't use it yet, right? Okay. So, would one of you send me an email and say, Keith, post right away quiz 3 and 4 on Moodle, the blank one? I'll post the blank quiz, and you guys can have a copy of the quiz while you look at these answers, particularly people at home, maybe. You don't have a copy of the quiz in front of you, do you? For this one. Actually, there's only 3 of you here, so you will have one in front of you. 4 of you here. Can't count. Why not? So let's do C. Sign an agreement with anyway, would one of you send me an email? Is somebody doing that? So you have a phone number, send me an email. Are you on Outlook with your phone? K. Richardson.
Yeah.
Yeah, okay. Bellman.edu. Yeah. Thanks very much. Just remind me to post this on Moodle so everybody's got it. Okay, C. Sign an agreement with a cleaning service to pay the 1,000. Actually, we gave him 2,000. That's what it was, wasn't it? So it's going to be credit cash, 2,000. And because we have not used it up yet, it is prepaid cleaning. You like that?
Yeah.
So call it something like that. Prepaid cleaning services, something along those lines. Okay, then in D, it says lent 3,000 to one of the investors who signed a note due in 3 years. So I gave up 3,000 this time, right? And I have a note what? Receivable. So that's an asset, right, guys? Note receivable. And I hope this is getting easy. You're learning a lot about business, not just accounting here, you guys. What do people do in business? All kinds of stuff, actually. Okay, that's D. Okay. Issued common stock to additional investors who can, gosh, I really went after stock today, didn't I? Issued common stock to additional investors who contributed equipment value of 15,000 in exchange for the stock of the company. So what did they get? Got the stock. What? Well, they issued the stock. So common stock. By the way, why am I crediting common stock? Because it's equity. You increase equity with a credit, right? Why do you increase note payable with a credit? Because it's a liability, increasing with credits. Okay, so So good. And what do we have? Equipment? Is that right, guys? Yeah, that is what happened, isn't it? Exchange for stock. Yeah, okay. Pay, now it's a little harder now. We're going to pay off 800 or 12,000 the principal from the note payable in B above. So the note payable in B was 16,000 there. We're going to pay off 12 of it, so now we'll only owe 4. Does that make sense? So we want to reduce that by the 12, and then we also have 800 of interest, don't we? So what's that going to be, everybody? How much cash did I give them? 12,800, of course. So you credit cash. What are you going to debit? Note payable. How much? 12 grand. Not bad, huh? And then what's the 800? It's for interest, isn't it? And we have not accrued this interest, so it's not an interest payable. It is what? Interest expense. Absolutely. That's it. Ta-da. Okay. And G. Okay. J. Johnson borrowed 11,000 for personal use from a local bank and signed a 2-year note. How about that one? Personal use? No entry. There's no entry there. They're borrowing the money for their personal use. It's not for the business. So you say no entry. You keep your personal records separate from your business, right? That's all it is. Yeah. Got a few extras. So. All right. So that's no entry, and you should have written that down. Don't just leave it blank. I don't know what you're doing. Okay? Everybody good? That's pretty easy, huh? I don't know why I have an extra space up there above, but I do. Okay. So just keep going in order, maybe. Number 2. Yeah. So we want to know what the effect is, and be careful. Read these things. I said in bold and underline, amount and effect, right? So give me both. Anyway, Chris collected 1,200 cash from customers for games played in July. And it's bold, right? I think I would change him to this when I'm working on him, unless I feel really comfortable with this stuff. And I guess it's okay not to. What happened here? Let's write the journal entry down and then figure out, what it would do. And this is, does it increase, decrease, or have no effect, right? Okay. So we did a bunch of these. Get it ready for the quiz, didn't we? Chris collected 12,000 cash from customers for games played in July. We are doing up above, it says the month of July. If the games were played in July and they were paid in July, what's that going to be? Debit. You got paid, guys. Cash. And credit what? Some sort of revenue. Bowling revenue. I don't know. Okay? Service revenue. So it's debit and asset, credit revenue account, right? So the debit to the asset increases the assets by 12,000, right? The credit to revenue, that's this one. The credit to revenue increases revenue by 12, right? There's no expense over there, is there? There's no liability, so what must be the case with equity? 12 here, nothing here. It's got to be what? 12. So that increased equity by 12, and of course it did. How'd that happen? Revenue's up by 12, expenses did not change, net income's up by 12, and we got them all, don't we? So I'd say increase assets 12, no effect on liabilities. Increase equity 12, increase revenue 12, no effect on expenses, increase net income 12. Easy? Especially when there's no pressure on you, right? Okay. Get to know it really, really well. There's not much pressure when you're doing it on a test either. Okay? You get there. That's A. Try the same thing with B. And I don't care if you write this down every time. But if it helps you, do it. But for thinking through it, it does help, right? You have to sort of envision in your head otherwise. Sold 6,000 in bowling parties to corporate customers, receiving 1,000 in cash and the rest on account. This is about the same as the last one. What do you do? Debit what? What do we get? Cash 1,000. What about the other 5,000? What is it? Account receivable. Excellent. And the 6,000? More bowling revenue, same as that. You guys like that? That's pretty simple, isn't it? Both of these are assets, aren't they? So what happened? Assets are up by See a liability over there? I don't, so no effect. Equity must be up by 6. Because revenue is up by 6. Is there an expense in that entry? No. So is net income up by 6? Yes. Is that why equity's up? Yes. I get paid for doing this. It's crazy, isn't it? You guys can get paid for doing this too. Understanding what happens is really important. Not doing it. Doing it. Computer do it for us. Okay? We got it? Are you getting these right, you guys? Did you get them right? You did that? I know you don't have it in front of you, but...
The first one I got right.
The second one, you talked yourself out of it?
The second one, I did the asset and equity right, but I put the revenue is only 1,000 because I thought it was
I don't have revenue unless I got paid. No. I get revenue if I do the work. Right? It's true, isn't it?
Yeah.
If I work really hard this month and I earn $10,000, but they're not going to pay me till next month, how much did I earn this month? $10,000. In fact, they didn't pay me. If they're going to pay me. If they're never going to pay me, I don't have the revenue. But if they're going to, if I have an account receivable and it's collectible, right, they have both the intention and the ability to pay me. So that'll get away from that one. Separate cash flows from revenues and expenses, okay? I earn revenues when I do the work. I incur the expense when I incur the cost, right? Use up something. So good. That's all right. By the way, how many points are there on this quiz? 30, right? Is it 30? How many points are on the quiz? 30. On the test, how many? It is 30, isn't it? Oh, I said 25? Oh, shoot, I screwed it up. It's 30. It's got to be 30. Right? Yes, on the syllabus there, 30. So glad I noticed that, or you guys noticed that, because I've got to convert everything to be 30 points.
So is everything is worth less on the test, or is it going to be short?
Well, it's gonna be about double one of these.
Mm-hmm.
So, but it's gonna be 100 points, so about twice as many points per question. Does that make sense?
Mm-hmm.
So, about twice as many questions, but also twice as many points per question, because it's almost 4 times as many points. That make sense?
Yeah.
Okay. Yeah. Math makes sense again. Let's do C. Receive 2,000 from customers on account. What did we receive? Cash. What don't we have anymore? On account? Account receivable. What are both of those? Assets. I don't think I need to write down the accounting equation for that. I increased assets and reduced assets for exactly the same amount, so what happened to assets? Nothing. No effect. What happened to every other account seeing as if there's no other account in there? Nothing. Any all the way across. Did you do that one? That's annoying, isn't it? Most people miss it. Oh, well, if you said 2,000 on both of them, I'll give you credit.
I put 2,000 increase and 2,000 decrease.
Yeah, only, yeah, that's right. But that's ultimately no effect, right? You wrote down the amounts, you're good. Okay. D. Men's and ladies bowling leagues gave Chris a deposit of $2,500. So what did you get from them? Cash? Ready cash? Everybody agree with that?
Is it like prepaid?
They have a prepaid. Oh, wait a minute, it's debit cash. They have a prepaid. What do I have? Unearned revenue. Yeah. Was it 2,500? It'd be debit cash, so you have to credit something. What's the deal? They gave me cash and I gave them nothing. Well, I really gave them something. I gave them my promise to let them bowl for free in the future, right? Okay? So it's not free, they already paid for it, but they don't pay me again. So what do you want to call it? Unearned bowling. Okay? That's that liability, isn't it? Now, folks at home and folks here, don't get discouraged if you miss questions, right? Learn it. Get it down. Get it solid. And then when you take the test, it'll be much better. And then by the time of the final, you'll be walking through this stuff. It'll be a joke. Okay? That's what we want. All I care is when you're finished with the class, you know what you're doing, right? How we get there. We get there with pain. Gotta get, yeah. Study hard. Okay, debit cash, what's that? 3 cents. Credit unearned bowling revenue, what's that? Increased liability. All right, is there anything else over here? No, nothing else. So no effect, no effect, Decrease assets, increase liabilities by the same amount. Boom. Okay. I guess we got one more. E. Chris paid $3,000 for the June electricity bill and received the July bill for $3,200. What is that? Okay, let's do both of them separately. They pay June's bill. What would they have done in June? What would they have recorded in June? Now we're doing July, we're not doing June. But just what would they have recorded in June? What do you think happened in June?
Utilities payable.
They'd have utilities payable. I think so, which would be a liability. For how much? 3,000. What would they have debited last month? Utility expense. Excellent. That's true, isn't it? Now that happened in June. What's going to happen relative to that in July when they pay it? July is what we're working on, right? Not June. Okay. So what would they do when they pay that? Sure, the payable goes away. And credit what? Cash. Excellent. What else would happen? There's more. Another bill for $3,000. Also in July, right? Both of these are in July. What's that one going to be? Utility bill for July. Wait a minute. The first one was $3,000. I apologize. These were all $3,000. The one for last month was $3,000. True. You guys didn't even stop.
Okay, so he got the bill for June, but paid it in July.
Yeah, but in June, what would you have done? You would have accrued it in June.
Okay.
So this was hard. We have an accrual of expense in June, huh? Debit expense, credit the payable, that makes sense? Then we pay it in July. Right? That's the payment. Debit, utilities, payable, credit, cash. Make sense? And then what else would we do in July? We'd record July's bill, wouldn't we? Which would be what? Debit. Utility expense, just like here. Only this time it was $3,200. Sorry, I messed up the amounts, you guys. It's hard enough without me doing that. And credit what? So you haven't paid. Utilities payable. Good. So when you answer this one, it looks kind of screwy, doesn't it? It's all of that, isn't it? That makes sense? So now, that we know that, let's do it. Assets equal liabilities plus equity. Revenues less expenses is net income. We just have two entries together. Okay, what happened to, what happened to utilities payable? Decreased and increased, right? Utilities payable went down with a debit of $3,000. Would you guys agree with that? Down by $3,000. But then what happened? It goes back up by $3,200. What's the net effect on liabilities? Increase of $200. I think so. Okay. What happened to assets? Cash went down by $3,000. Assets went down by $3,000. Is that right? Huh. What's the case going to be on equity? Down by how much, you guys? It's got to be 3,200. 3,200 down, less 200 up is a 3,000 down, right? Is that going to work? What happened to revenue? Nothing, right? No effect. What happened to expense? Up by 3,200. True? What happened to net income then? Down by 3,200. What caused the equity to go down by 3,200? That's it. More expense. And I've got my answers, don't I? This was hard. Assets down by 3,000, decrease. Liabilities up by 200. Equity down by 3,200. Revenue, no effect. Expense up by 3,200. Net income down one that is complex like this? Write it down, write it down, write it down. Okay. All right, good. I just threw that in there to be fun. Something fun. Give you a little challenge. All right, let's do number 3. This wasn't a real long quiz, but it wasn't horribly easy. And then there's a little deceptive. Well, this isn't bad, this isn't bad. You got to quit it. What happened? That's okay. It's just a quiz.
Oh, is this a question that?
Yeah. You can keep that one. Let's do extras. I'm going to post them out on the move so everybody's got it. All right, number 5. So this is just like one from the practice quiz, huh? I mean, I didn't even change much. I hope I changed the numbers around a little. Okay, so if you figure this out, you got it made, huh? How would you approach this? You know, you look at something and I'm giving you a whole bunch of balance sheet and income statement accounts. How about set it up like a balance sheet and income statement, which is the accounting equation, of course, for our purposes at this point. But yeah, that's a balance sheet. It's an income statement. And we're going to do 2 years, so we're going to have beginning and ending. And I'll do this twice, right? And we're going to separate contributed capital and retained earnings, I think. I think this one does, doesn't it? Okay. So what do you know? Let's go through this. Crank it out. Okay, do 2011 first. 300, I don't care. 330 ending liabilities, is that right? Yeah. And I reminded you to be careful the order of these things, all right? There's different orders. Okay, so the oldest year and then the newest year. I don't know why I did it in that order, but I did. Okay, so 330. And then what else do you know? Current year investment was 50?
Yeah.
That would be a credit to contributed capital, wouldn't it?
Wait, so is it easier to work from like 2010 to 2011?
No, it doesn't matter which way you go.
Okay.
No. We could have put the retained earnings at the beginning down. It'd be fine. Just put everything down once and only once. Make sure you get them all. So there's the 200 beginning retained earnings. There's the 330s ending. We're just going to write down what we know and try to solve this now. Okay? So it doesn't matter which direction you go. We got the current year investment, and then it says 60 is it net income or net loss? Net income. So 60 here, right, guys? But also, where else would it be? Increasing retained earnings, right? Everybody good with that?
I have a question.
Uh-huh.
So retained earnings from 2010, is that also
It's-
part of 2011?
No, that's beginning.
Correct.
This is beginning.
Okay.
This is net income. If we took out our dividends, we could get the ending. Make sense? Or if we had the ending, we could get our dividends. We'll put the dividends over here. Okay? That working? So I'm just writing down what I know. That's all I'm doing. Assets at the beginning were 950. That was beginning, right, guys?
Yeah.
Okay. Revenues is 260. That's a credit, right? Net income's a credit. Okay, good. Dividends are 30, so the dividends would be a reduction in retained earnings, wouldn't they? Right? Because it just is. The owners are taking out some of the income. Yeah.
Now, what's on the left? What's on like the debit side of contributed capital?
Oh, if owners bought back some of the contributed capital, bought back some of the stock, you debit it.
Okay.
It's kind of unusual. Although I gave you that on the quiz, the practice quiz, didn't I?
Yeah.
Yeah, but it's kind of unusual. What they do is they buy back treasury stock and then they might retire the stock. That happens a lot. Or they might resell it or something. You can buy your own stock, but they call it treasury stock, not a reduction of contributed capital, really. Okay. So what else do we know? Anything? Contributed capital, ending or beginning? That's ending, isn't it? Okay, so did you guys write all this down and then solve? Get everything down first, then you solve. Now look at this. There are 2 unknowns here. Can I solve either one of them? How do you solve 2 unknowns at once? You can't, right? You got to get one of them. There are 2 unknowns here. Can I solve either one of them? No. Oh, look, there's only one unknown. Can I solve it? Sure, 2 260 less 60 is how much for expenses, guys? 200, just like that. You got it. Okay? What else can I solve? Let's see. I don't know beginning equity, and I don't know beginning contributed capital, and I do know ending. That's two unknowns, isn't it? Can't do it. How about ending? I know 470, my ending contributed capital, but I don't know retained earnings, and I don't know equity. I can't solve it. What can I solve? Look at contributed capital. What did it end up at?
470.
What did it start at? I don't know, but how much was added? 50. So what did it start at? What was it? 420. I got that one. Everybody agree? I'm better off now because now I have beginning retained earnings is 200. Contributed capital of 420 plus retained earnings of 200 is how much? 620 beginning. Can you do liabilities now? Absolutely. What's the beginning liabilities? 950 less 620 is 330, is it? Same as the ending. Okay, all right. That's it, isn't it? Did you do math right? That's beginning. Beginning contributed capital plus beginning retained earnings is beginning equity. It isn't. If I know the beginning equity is 620 and I know the assets are 950, I can take the difference and I have what liabilities is. If you really understand these relationships. You guys are giving up on remembering now and computing now, thinking now. Oh, now I can find ending retained earnings, can't I? You know the beginning is 200, you know you added 60 net income, and you know you took out 30 dividends. What's the ending? 230. That's the ending. And once you have that, what can you add it to? The ending contributed capital. How much does that give you? 700. So if you have 700 ending equity and you have 330 liabilities, what must be the ending assets? 1030, is it?
Yeah.
I'm done. Did you guys get these right? Pieces of it?
Okay, wait, now where did you get the 60 equity?
Okay, I knew the 200 beginning retained earnings, right?
200 beginning retained. Okay.
That's just given to you.
Yeah.
And then what I did was I knew the 470 ending contributed capital,
Okay.
and I added back I deducted the 50 that was contributed during the year to get to the beginning. So what I did was I took 470 here, less 50 gave me 420 at the beginning.
Got it.
Once you know the beginning contributed capital and the beginning retained earnings, you can just add the two together.
Okay, I understand.
Got it?
Yeah.
420 plus 200 is 620.
Yeah.
You're getting there. And once the light turns on, it's going to be easy. Just keep pounding. Keep pounding. It just makes sense for it. So can we do exactly the same thing with the other one? Why don't you do it real quick, you guys? Go ahead and do the other one. Make sure you've got it. Just write down everything you know. Solve for what you don't know. That's all you do. Actually, lots of times that's all you do. Not just in these problems. In real life. And in equity we have contributed capital and retained earnings. Do all that. Everything you know. then it's 10 hours and 12. 12 hours less. That'd be nice. I wish I was more efficient. Always. Okay? Pencil it down. Good. All right. What do we know, you guys? You go down either. I guess I'd go down the first column and then the second column or something. I don't care how you do it. But beginning balances are what? Liabilities 220. Do that one first. Doesn't matter what order. Just make sure you write everything down once and only once. Okay? Be careful. And then retained earnings beginning is 110. You put things in the right places. And then when we go over to the ending, we've got ending liabilities of 270. And it went up 50 during the year. Retained earnings ending is 160. Right? So it went up by 50. Net income was at least that much. Oh, dividends are 40 though. So now I could probably go ahead and calculate net income if I wanted, but I think I'll wait. Current year investment was 50. Got added, right? Added. Okay, expenses are 150. And assets at the end are 750. Okay, so now we look around for things we can solve. Two unknowns. Can't do it. Oh, one unknown I can do it. Actually, you're right. What, 750 less 270? What'd you guys get? 40. Okay. Two unknowns can't solve it. Oh, one unknown, I can do that one. How about that one? 110 less 40 made 70, right? What's net income? 90. Got it. Now you guys ready? Agree on that?
Yeah.
We're good? Okay, so that's 90. Okay, so what was the other one we just saw? The equity, was it? Okay, so that's 90. So if net income's 90 here, guess what net income is up here, of course? 90. So what was revenue? 240. We're doing good, aren't we? Down. Okay, what else could we do? Oh, well, really? What can I do? I can get the what contributed capital? Ending, yeah, because I know ending equity. And I know ending retained earnings. So what's 480 less 160 must be the contributed capital. Is that right? That's what you're saying, right? So how much is that? 320. So ending contributed capital is 320. Well, now what can I do? The beginning contributed capital must be 50. Less than that, it is 270. Excellent. Okay. So now what can I do? I can take my 270 contributed capital at the beginning and add 110 to it. What do you have? Is that 380? Yeah. Now what can you do? Add that to the assets. And where are you? 600. We've done every single thing. How many of you had all of it? What happened? You didn't have all those? Yes.
I got them right now, but on the quiz.
Oh, yeah, I don't care on the quiz. You can do it now.
I got it right on the quiz, but when I tried to do it just now, I didn't get it right.
What?
But those are my answers on the quiz. I don't understand.
You did something. Yeah.
I was off by like 40 because instead of doing the beginning retained earnings, I put the ending one.
Oh, you flip-flop.
Yeah.
Easy to do. Yeah, you put the 160 as beginning and the 110 ending, and that'll throw you off by the difference.
Yeah, that's exactly it.
Yeah. So, do you see what you did wrong this time? You did it right on the test, but wrong here.
Yeah, because it's not unknown.
Okay.
You know what I'm saying?
How'd you do? Did you get it?
Yeah, I just missed revenue.
Got to write everything down, right? Once you pull that net income up there, right, you can't miss revenue again. Okay? Lay the thing out in a template like this, and then put everything you know in, and as you learn something, use it. Don't do them independently. It's all one problem. Okay? One big problem. Financial statements are one big monster problem. Right? Any company. One big problem. All right, good. Now that I've got you guys completely demoralized, let's do, just a quiz. I wish we had a weekend. I apologize, we don't. Every time it snows, this happens. Crunch. So we don't reduce your knowledge set because of weather. You think? It's not going to pay off. You can't do that. Happy Moon Restaurant. Okay, now these all of a sudden, it looks just like the first question, but oh boy, it's not, is it? Okay, and these you have to do some work on. Okay, so, and it's only 7.5 points, just like the first one, so that's kind of lucky. so these guys need adjusting journal entries at December 31st, 2011. Answer any related questions. If no adjustments required, say no entry. Okay, so in A, this is number 4. In A, what do we got? The restaurant sublets office space to a consulting company. So they rent an office building or something, and then they subrent some of it that they're not using to somebody else. They're going to get $24,000 per year. All rents are paid through October 31st, 11, but the company has not yet received rent for November and December. So apparently they're getting monthly rent from them, huh? So it's $24,000 a year. So how much is that a month? $2,000. So how much do they owe you? $4,000. And they promised a check in January, and you trust them for it. So what do you have? You have a rent receivable. For how much? $4,000. And why do you have a rent receivable? Because they used your property and you earned rent revenue. Sometimes we'll use rent income, rental income, but it's really revenue. Because we'll have some expenses associated with that. That's A. Not bad, huh? Accrual or deferral? That's an accrual of revenue. Even. You didn't have to say that. But you know what? I might ask you on a test. Is that an accrual or a deferral? That was an accrual. I accrued the revenue even though I haven't got the cash yet. What do you do when you get paid? Debit what? Cash. Right away. Rent receivable. Thank you. Okay. I don't think I had to do that, did I? I might have. B. Hired a new professional chef whose salary will be $1,500. Will begin work next year. Begin work tomorrow, which is next year. What do you think? No entry. Nothing happened. It's just an agreement. Keith, give me half a point for that. What a deal. Okay. No entry. Nothing happened, right? What's different about that then on the first question when they signed an agreement and made an advance payment? Well, they made an advance payment. Cash changed hands, right? There's a transaction. Just signing an agreement isn't a transaction. Okay? Got it? Nothing, no business got transaction. Agreement to do it in the future. Let's try C. On July 1st, a one-year insurance policy on equipment of $2,400 was purchased for cash and debited to an insurance expense account. So what they did was they debited cash, right? Earlier, they debited cash. Whoops. They're acquiring. They credited cash. They bought the insurance policy, didn't they? They credited cash for $2,400, was it? Mm-hmm. And they debited what? What account did it say it went to? To insurance expense. So I could have said a nominal or temporary account. It went to insurance expense. So insurance expense has $2,400 in it, doesn't it? Some of it will be used up. That's going to be the balance we want in insurance expense when we're done, right? Some of it will not be used up. What are we going to call that? Prepaid insurance. Okay. So apparently relating to this policy, nothing's in prepaid insurance. It's 1 year. It's $2,400. It was July 1st. How much time went by between July 1st and December 31st? 6 months. So it's going to be half of it, isn't it, guys? So half of it is earned. The insurance expense, or is used up, I'm sorry. The insurance expense should not be $1,200. What should it be? Or $2,400. What should it be? $1,200. Should be $1,200. How much should be prepaid? Yeah, you haven't used up $1,200. How do you get from 0 to $1,200 in prepaid insurance, and at the same time go down from $2,500 to $1,200 in insurance expense? Debit, prepaid insurance, bring it up to where you want it to be, and credit insurance expense. All you have to do. Good? Trying to remember if you did it right or not. You write down the key accounts, that's hard to do. You did not? Yeah, that's a mistake. It just is. I'd probably still write it down if I wanted to be sure I was right. Why not? Sitting and thinking about it, I can probably write it down and think about it less. versus thinking about it longer without writing it down. You know what I mean? It's probably faster to write it down. I don't know. It's something extremely simple. I don't write them down. It's at all difficult for me. I'll get something down on paper. All right, good. Well, let's try D. Several new brides have made advance payments for wedding dinners. The amount of $8,000 was reported in unearned wedding dinner revenue account. What kind of account is that? Liability. So what they did was they debited unearned wedding dinner revenue, all right, for $8,000. Whoops. Why do I keep doing that? They debited cash. I got the cash from my kid. They debited cash for $8,000. Credited the liability, unearned wedding dinner revenue. True? So we have that liability with $8,000, and now they tell you that they earned $2,500 of it, right? Including that $8,000 is $2,500 they have now earned. So what I have is, yeah, this is the payment in advance. Including that $8,000 is $2,500, but the $2,500 is what they earned. That's at least that's what I meant. Yeah, they held the wedding dinner and they made an advance payment of $2,500. It's included in that $8,000. So what I have is unearned revenue, unearned wedding dinner revenue, with $8,000 in here, but now I've earned $2,500 of it. Make sense? And I have wedding dinner revenue that doesn't have anything relating to that particular dinner in it. So what I want to do is put the $2,500 in here, take it out of here. What's the ending balance in wedding dinner revenue? $5,500, right? $8,000 less than $2,500, right? So you would just debit unearned revenue, unearned wedding dinner revenue for $2,500. And credit wedding dinner revenue for
We don't have to
$2,000.
do the T-charts to figure that out, right?
Absolutely not. You had just written that down. I would have too in this case. On the prepaid, it's kind of nice to write it down because you're figuring out what portion is what. Yeah. Don't even have to get there. Right? All right. Let's try D. The restaurant has unpaid utility bills for December of $1,400. We're going to send it to accounts payable, and they'll pay it on the first Friday in January. What's this? I used utilities this year. Debit utilities. Things I used up this year are expense this year, right? Use it up in an attempt to generate revenues. That's why I pay my utilities, have the lights on, right? Whatever it is. Heat, lights.
So you're gonna just not gonna pay until the next year.
Separate cash flow from expense recognition. You have the expense when you use it trying to generate revenues. You have the cash when you pay out the cash. With different timing, right? You could pay out the cash at the same time, or you could pay it out in advance and have a prepaid and later use up the prepaid, or you could pay it later as in this case. So because I didn't pay it, what do I have? Utilities. I know. I have the liability, increase the liability.
Well, if we just put accounts payable.
I'll probably give you credit, but it's not an account payable. Usually, companies would usually call it utilities payable.
But in my question.
Same with rent payable.
Just so we put it in next year.
Oh, it's submitted to the accounts payable department. I'll take accounts payable. Yeah, things like that. They probably have a voucher system, which means everything runs through accounts payable. Okay. They write vouchers. So yeah, accounts payable. Seeing as I said that. Company borrowed $100,000 from the bank on a 1-year 6% note payable. What would they do at the time they borrowed the money?
Notes payable and cash.
Yeah, debit cash, credit notes payable for $100,000. What date was that?
The first.
So how many months are there to the end of the year? 4 months, yes, ma'am.
So if we had like paid off would it be utilities payable debited?
And credit. Cash.
Cash.
Yeah, because you pay with cash, right?
Right.
Yeah, if the next month you paid it, that's exactly what it'd be. Debit the utilities payable, debiting the liability, credit cash. Here's that. Okay, so this is gonna be 4 months, is it? September, October, November, December? So we have 4 months interest, don't we?
Yeah.
So it's 100,000, what's the interest rate? 6%, but that'd be per year, so what is it? 4/12? So 1.5%, I guess, huh? No, 1/3, 2%. So 1/3 of it, right? So how much is that?
Oh, it's 0.5% per month.
Yeah, 0.5% per month. For 4 months is 2%. You got it. Yeah, 2% anyway, you guys. Of 100,000 is how much? $2,000. Okay, that's how much interest there is, and it's not due. It's a 1-year note, so it's not due until August 31st, right? And this is at December 31st. All these are, aren't they? So what do we do? What do we have? Every day that goes by, we owe them more interest because we are incurring the cost of borrowing the money, which is called interest expense, right? Cost of using the money is an expense. So how do you increase interest expense? With the debit. How much is the interest expense? 2,000. What do we have, seeing as we didn't pay it? Interest paid. Got it. That's it.
I think it's so much harder than it needs to be.
Yeah. Once you see it and you just realize.
Like I did that, but then I tried to calculate like 4 months of the 100 grand, and like it got really messy. I tried to take a fourth of that, and like it's really bad.
Well, 6% of 100,000 is. Oh, it wasn't a fourth; it was a third. 4/12.
Yeah, that's what I meant. Yeah, I had like
So if you had 6,000 and you
30
divide it by 3,
No, not the interest, the 100.
Oh, no.
Yeah, I
You're
had,
not.
like,
You're
this-
not. You didn't say you were making a principal payment. You weren't paying off part of the principal. That's probably what you're trying to do.
Yeah, I did both.
And we'll do that later. I will actually pay off some of the principal later. So pretty good stuff.
Yeah.
Good scores, you think, guys?
I think I got like a B.
They're like a B
Middle of the
plus.
road, I made some dumb mistakes.
You'll be all right. You'll be all right. So, what else do you want to do? We got another hour, I guess, if we want. We could do something. Were there any questions on the test that you worked that you'd like to work? Anything like that? Or problems in the book you'd like to work? We don't have to do anything else out there, obviously. Get a drink of water. Bring it. Shower. transaction was that they issued a note to buy equipment, remember that? So we debited equipment and we credited cash for the down payment and we credited notes payable.
Yeah.
And I tell you what the interest rate and the depreciation is gonna be?
Yes.
You don't need that information yet, but
Okay.
you might need it later. So
Okay.
sometimes I'll give you information that you use, that you don't use, but just use what you need.
Okay. But, and
And just relax and figure, okay, what am I doing right now? Okay, so what am I recording?
And, but so for all of these, like, in the top, it was like, not all of them may require an adjusting entry, but all of them did, except for
Except for one.
village.
Yeah, that's it. You got it. But it could have been more. I could have given you other things that were not a transaction, or where it's already recorded properly.
Okay.
If it's already recorded properly, you don't need to make an adjustment, right? Do that. I'm gonna be blinded. Trust me. Wish that one didn't go down. You know, they have separate controls.
Is common stock and capital stock the same thing?
Yeah, capital stock includes common and preferred. So it's like stockholders' equity includes owner's investment, contributed capital, right, and retained earnings. Included in contributed capital is capital stock, it's a type of contributed capital, and it's also donated capital. And then the contributed capital is common stock, preferred stock, right? Or the capital stock, whether it's common stock or preferred stock. So just another level.
Could we do like number 11 on the test?
That's the one with
Where it wants you to make the balance and income statement for the
yeah, she's running a copy of the basic, the test for me. I didn't think we should.
Could you tell me laser rifle and
Oh, sure. On number 10 on the test, what kind of an account is accumulated depreciation? What less accumulated depreciation? Building less accumulated depreciation. Contra assets. Which one's the expense account? Depreciation expense.
so I would write an asset
When you do
or
the
contra
entry,
asset?
you say contra asset. Contra asset. Because it's got opposite of the normal balance. So when we record depreciation, what do? We debit depreciation expense, right guys? Reflecting that we used up the asset. And credit accumulated depreciation. We don't credit equipment or building because the equipment or building didn't really go away, just its utility value went away. Its usefulness went away. So this is the expense account. This is a contract asset. Okay, make sense? What's the next one?
Contributed capital,
Contributed capital is what, guys?
equity.
Equity. Good. Next one.
Cost of goods sold,
What's that? It's the major cost of getting my sales. I had to give them the product I sold. Expense, absolutely. Next one.
income tax expense,
Obviously, expense. Yeah.
interest expense,
Obviously, expense.
interest payable,
Is that payable?
Liability.
Liability.
prepaid interest, is that an asset?
Asset. Paid in advance. Haven't used it up yet. It'll be an expense later.
Salaries payable, a liability.
Yes.
Unearned rent, a liability.
Liability. They paid me. I've given them nothing so far. I promised to do the work, and I will do that, of course. So never earned rent.
Inventory asset,
Yep. That's product I'm holding and I'm going to sell to somebody, right? All the groceries at the grocery store. Okay.
accounts payable, liability.
Yes.
Land asset,
Yes.
rent receivable asset,
Yes. Receivables are assets.
income tax payable liability.
Yes.
Building asset,
Yes.
wage expense liability.
Whoa. Wage expense?
Yeah.
That's an asset. Wage expense?
Yeah,
Wage?
is that an asset?
I don't think that's an asset. Expenses are things I use
No, I
out.
said it was a liability.
Yeah, it's not though. You
So
might have a
it's-
liability with wage in it, but let's say my employees have earned $10,000, but I haven't paid them yet. What would I do at the end of the month? Debit wage expense for $10,000 and credit wages payable. Right? That's the expense. prepaid expense, credit cash?
With salaries.
Yeah, salaries are monthly people, wages are hourly people. Are there more?
Accounts receivable asset
Yes?
and equipment asset.
Yep.
That's all.
Okay. Good. Good. Did it work?
No.
Oh, of course not. Okay, anyway, you guys can read me, not when you want it to, right? You guys can read me what's on the statements, but let's think about this. We are going to do a balance sheet, we're going to do an income statement, and we are going to do, what, an equity statement, does it say?
Balance.
Or just balance sheet and income statement? Okay, all right. So, and we could do an equity statement too, maybe we will. No, why not? I think I gave you enough information. So, what would you do for a balance sheet? What are you going to put on? That's true, assets equal liabilities plus equity, that's balance sheet, isn't it? But what are you going to put right at the top of the statement? Maybe the company name. What's their name? Price, Co. or something. What are you going to put on all three statements? How about Price Co? Let's always do that, okay? Make sure you put the name of the company up there. And in real life, we type it out really nicely and look beautiful, and we use exactly their name. Okay, we don't abbreviate anything. Quiz or test for you. All right. So what are we going to put on the balance sheet? We'll probably call it a balance sheet. Do you think so? What are we going to put on the income statement? Probably income statement? Be sure and do this. What are we going to put on an equity statement? Equity statement? Or statement of equity, and you call it statement of income if you want. You can call it balance sheet a statement of financial position if you want, but you do that. Let's put dates on it. Now be careful with this one. The balance sheet is a picture of one point in time, isn't it? So what do we write down? The year end. What day is the year end on this guy?
May 31st.
May 31. Did you give it a year?
2012.
All right, fine. Okay. It's not for a year ended because you don't close those accounts, right? They're permanent accounts, assets, liabilities, and equities. On the income statement, you put for the year ended May 31st. Okay? Make sure you do that. For the year ended. This is a good one to go over. Equity statement, also for the year ended. You start with the beginning and go to the end, huh? For the year ended. May 31st. I will actually...
Equity statement.
Huh?
Why would be an equity statement?
Because in the book they did it, so I don't know if I asked for it on the test or not. I might have. Yeah. Doesn't matter. You'll know how to do it anyway, right? We had problems where you did it. Okay. On the balance sheet, what do I have on the balance sheet, you guys? Assets. And you can either put the liabilities to the other side, or you can put them down below. It doesn't matter. People do it a lot of times like this, but you make sure the assets equal the liabilities plus equity. And then so I'll have equity down here, sound good? And when I add the liabilities plus the equity, it's going to total the assets, okay? What am I going to put on the income statement, you guys?
Revenue, expense,
Yeah, revenues. And then I'm going to put all the expenses. And then I'm going to have net income down at the bottom line. You guys good? So we'll write everything in here. We might not have them in exactly the right order. Really what we should do in the assets is we should do current assets separate from non-current. We should do current liabilities separate from non-current. Everything should be in the appropriate order. Don't worry about it for our purposes here. Just get the assets with the assets, liabilities with the liabilities, equity with equity. Got the idea. Revenues in the right place with the revenues, expenses with the expenses. And in the equity statement, we'll start with the beginning, and we'll work our way down to the ending. Okay, this will be beginning down to end. Okay, and what we'll do is contributed capital, common stock maybe, and retained earnings. It doesn't know how many accounts they have. Okay, so let's just go through the accounts. What are they? What's the first one?
Okay, well, it's like the way it's set up, some numbers are on the left and some are on the right. So is that already showing where it's debit and where it's credit?
Yes. They're on the left, they're debits. If they're on the right, they're credits. You bet.
Okay.
Or I might say debit next to it or credit next to it. All right? If I say they have normal balances, what does that mean? Assets are debits, liabilities and equity are credits, revenues are credits, expenses are debits. I could do that too. I could just say normal balances. But if I put them in the columns, yeah, that's left is debit, credit's right. That's excellent. Okay? So what's the first one you got there?
Accounts payable for credit.
Okay, what kind of account is accounts payable?
I feel like
Liability. Let's write down accounts payable. What do you say? How much was it?
12,000.
Yeah, and you don't need to put brackets around it. It's okay. Right? We know it's a liability. We know it's a credit. Right? Okay, because liabilities are credits. Okay, what's the second one?
Accounts receivable 15.
That's an asset, isn't it? Ah, this isn't too bad, is it? Look how fast this will go. We get organized, huh? It's just the accounting equation, all we're doing here. Balance sheet, income statement. What's the next one?
Accumulated depreciation.
Ah, where does that go? We're going to have building or equipment less accumulated depreciation, aren't we? It's an asset, but what kind of balance did it have? Credit, of course, right? Less accumulated depreciation. And how much was it?
20.
So I'd put brackets around that one, wouldn't you? I'm sorry, I remember it's a credit then, okay? Less accumulated depreciation. Excellent. What's the next one? Oh, by the way, put check marks next to them as you use them. You don't have to use them in order, I don't care. You could jump around and find all the assets first and then all the liabilities, I don't care, right? Put a check mark next to it if you use it, so you don't use it twice, right? What's the next one?
Building for 100.
Oh, I bet you that's what they're depreciating. So the remaining book value on the building is how much? 80. Do they have equipment on there somewhere?
Yeah.
Oh, okay, so we're going to have to do equipment too, so I won't put it total yet. Okay, what else? What's the next one after buildings? We'll just keep going.
Capital stock for 50.
Where does that go?
That's a credit.
And that's
Equity.
equity. Yeah, how much was it?
50.
Yeah, that's your contributed capital stock down there. Excellent. What else we got?
Cash for 10.
That's an asset. And notice I left room for cash because you're supposed to put the current assets first and put them in the order of liquidity. The most liquid, cash, to the least liquid. So go cash, receivables, inventory, then prepaids, probably like in that order. We do the same thing on the current liabilities. Current one's separate from the non-current and then in the order of liquidity. You guys read about that, remember? Okay. Okay, what else we got?
Cost of goods sold.
Where does that go? Expense on the income statement. Great, we got cost of goods sold. So I'm probably going to have sales less cost of goods sold is going to be what? Gross profit, gross margin. Okay? So, and then I'll have operating expenses below that. I bet I'm going to do that because they just gave me cost of goods sold, so I now know that. Operating expenses. All right, good. Revenues. All right, and then revenues less the cost of goods sold. Okay, or maybe just call it sales revenue would be a little better too. Something like that. Okay, so sales or cost of goods sold is how much?
That was 110.
110,000. Good. Okay, and that's a debit, right?
Cost of goods sold is an expense.
Yes, it is. Cost of goods sold is an expense. This is an expense. We just don't call it an expense.
Okay.
But I'm separating this expense from these expenses.
Okay.
So I've got sales is the revenue, less cost of goods sold is gross profit, less operating expenses will be paid. Okay, good. Good. What else we got?
Delivery expense.
Okay, let's put that under here. And see if I write down operating expenses, I can just write delivery and I don't have to write expense. What for? We know it's an expense because it's under operating expenses. You like that? Save me a little time. How much is that?
That is 20.
Okay, what else we got?
Depreciation expense.
How much?
410.
410 then?
Yes.
Okay, what else we got?
Dividends.
Ah, where does that go? Equity comes out of retained earnings. Okay, so when we get retained earnings over here, if they don't ask for an equity statement, what I'll do is I'll do a little schedule like this. Retained earnings. Okay? I'll do beginning retained earnings less dividends. How much was the dividend? So let's do it without doing the equity statement first, and then we'll come back and do an equity statement if we needed one. Okay? That make sense? So this little T account is retained earnings. So I've got dividends is 20 coming out of there, right? Okay, good. That's where dividends goes. Okay, check that one out. What else we got?
Inventory for 25.
What does that mean?
Equipment.
Oh, equipment first?
Yeah, sorry.
Okay, equipment is a what?
Asset.
Yeah, so it's equipment and buildings, isn't it? How much was it?
That's 20.
Good. What else do we have?
And then inventory for 25.
Okay, and that's an asset, right? Is that everything?
Nope, notes payable for 18.
Where does that go?
Liability.
Yeah, good. Does it say how long the note payable is going to be out for?
No.
If it was less than a year, it's a current liability. If it's more than a year, it's a non-current one. That's how you classify it, right? You call that classification, which section you put it in. Okay? All right, so we'll just put it in liabilities. What else we got?
Rental revenue for 20.
Oh, so we have some other revenues over here. So I could put sales, I guess I'm going to do cost of goods sold. I might put rent revenue, it could go down here if you want. We're getting kind of fancy now. But if you put it up there with the sales, that'd be just fine. How much is
So
it?
is the sales a revenue? I thought that was an expense.
Sales, no, sales is a revenue. Cost of goods sold is the expense.
So those are two different sections?
Yeah, this is a revenue here. This is an expense here. That's going to be a gross profit, the difference between the two. And then I'll subtract my operating expenses and get income before the rent revenue, and I'll add back the rent revenue.
Okay, so we have to have all that. As far as like, when you're subtracting, like, and making a gross profit and stuff, instead of just like labeling.
If you listed the revenues and added them up, and you listed the expenses and added them
Then
up, and
it'd
you
be
took the
okay.
difference, I'll be okay.
Okay,
But we're going to do this real soon anyway,
okay.
like the next chapter. Okay, so, yeah. So, what else do we have? Oh, what was rent revenue? I'm sorry.
That was 20.
Okay, now remember that's a credit. That's increasing income, right? Rent revenue is increasing income, right?
Yes.
Okay, good. All right, so it's a credit. Everything else here is a debit so far in the income statement. What else do we have?
Retained earnings, and that's,
That would be beginning,
yes.
because they haven't closed the books yet, right, guys? So how much is the beginning retained earnings?
That's 50, and that's a credit.
Okay, good.
And, sales.
Okay, how much
is
was that?
a credit for 200.
Okay, so it's a credit. Sales is a credit, of course. I'll write credit next to it. You don't have to do that, but just so we remember, right, what we're doing this. That's a credit. Rent revenue is a credit. Everything else is a debit because they're expenses. What else we got?
Wage and salary expense for 40.
Wage and salary. Expenses 40. Okay, good.
And then we've got the total.
Total what?
Just the
Both
total.
columns total and the debits equal the credits. Let's hope.
Yeah.
We hope so. Or our statements won't work. All right, what do you want to do now? Add them up. Look at, what do you have for total current assets? In real life, we'd say total current assets.
We add all that up and then subtract the 20,000 from the depreciation.
Yeah, but first I'd add up the 10, the 15, and the 25, and I'd get total current assets first. Right there. How much is that? 50? You don't have to do that. You can just get total assets if you want. Okay, that's 50. And then these would be total plant and equipment. Building, plant, equipment, right? Sound good? So total plant and equipment, property, plant and equipment. Okay, 20 plus 100 less 20 is 100, right? So what's your total assets? This was a good one to do, guys. What's your total assets? 150, I guess. And if you work a few of those problems I assigned with financial statements, this could be a piece of cake for you, right? You know where things go. You guys are sharp people. Now you know debits and credits. Okay, let's assume that note payable is a current one. What's my total current liabilities, which is also my total liabilities?
30.
30. So if you know the assets are 150, what do you think the total equity is if the liabilities are 30? Total equity, what does it have to be? Make yourself think about that a minute.
120.
120, right? Because you've got 150 assets, less the 30 liabilities, you must have equity of 120, don't you? Okay. Are you guys all with me so far? It is, isn't it? So what's the total liabilities plus equity? We write it out. Liabilities and equity. What is equity? 150, of course. And you know what you could do right now? You could put down retained earnings. What does retained earnings have to be? Common stock's 50. Total equity is 120. What's retained earnings, everybody? gotta be 70. Now, we don't know that for sure, but we're gonna come back and look at that number. We'll come back and look at this one and make sure it agrees on the retained earnings, okay? Let's do the income statement. Oh, students always ask me, and the authors make suggestions on what order. Should we do the balance sheet first or the income statement first? Who cares? Doesn't make any difference. They have to tie together. It's called articulating. This 70 retained earnings has to be the ending balance over here, right? You guys with me on that? It's got to be 70 over here for ending. Either that or we got a mistake somewhere, right? By the way, what would that make net income? You could find out what net income is right now. You started with 50, took away 20, it made it 30. What's net income? 40. Let's make sure it is. We got to make sure it is, though. Don't just assume it is, right? Because we might have a mistake, right? Okay. Sales revenue was 200. Cost of goods sold is 110. What's gross profit? 90. And again, you don't have to have that line if you don't want it. You can put the sales and the rent revenue together up there, get total revenue, and then subtract all the expenses. Let's do our expenses, you guys. What do we have for operating expenses? Total operating expenses. Add them up. 20 plus 10 plus 40. What does it come up to? 70? Good? What's my operating income? That's the difference. My format's not very nice here. They should all be lined up. Total operating expenses subtracted from gross profit is what? 90 less 70 is what? 20 is operating income, and then we're going to, that's a credit, right? Revenues less expenses is a credit, and then we're going to add the rent revenue credit, and what do we get? What's 20 plus 40? Or 20 plus 20? 40. 40. Boom! Everything's right. You like it? We've done the balance sheet and income statement now. Now, if it asks for an equity statement, what would you do? We have contributed capital, common stock, I guess, is all we had, right? You might have additional paid in capital and other stuff going across the page. And we have retained earnings. So this is a very simple one. There's just two columns here, right? And what we'll do is we'll take the beginning, and we'll add any investment during the year. Did they invest during the year? Was there any investment?
It's like dividend.
They started with 50. Oh, a dividend is a reduction of retained earnings. See, there's the dividend coming out. It's not an expense. It's a direct reduction of retained earnings. You debit retained earnings and credit cash, or debit retained earnings and credit dividends payable, or whatever it is, okay? So the dividend's going to come out of retained earnings. So there is no investment. What do we start with in common stock? 50. So what do we end up with in common stock? 50. This is going to be easy, isn't it? All right, retained earnings. What's the beginning? 50. What's the total equity at the beginning then? What do you think the total equity is? 50 plus 50, it was 100, wasn't it? We have no additional contributed capital. We could have, right? How much was our dividend? 20, and that's a debit, right? So I'm reducing debit, reducing retained earnings. And then what else is there? Net income, right, guys? How much was my net income? 40. So look what I've done in this retained earnings part right here. I just wrote down the 50, the 40, the 20, and what do I end up with? 70. That's all there is to it. And what do you have for total? We total across 0, 40, 20. Where's my ending equity going to be? So obviously 50 plus 70 is 120, which is, of course, the 100 we started with, plus no contributed capital, plus net income of 40, less dividend of 20 is 120. Ta-da. 50 plus 70 is 120. Got it? So no big deal doing an equity statement, is there? Yes, sir.
Where did you get the 100 from for total equity?
Oh, the beginning? I added 50 plus 50.
Okay.
That's it. I started with that much. I know that was the beginning retained earnings, right? And I know that was the beginning equity because they didn't contribute any during the year. Look. That's happening. That wasn't too hard, was it? I got it all on one page.
Do you want to add us through it like this for the test?
What are you looking for on liabilities? Payable, right? It says payable is a liability usually, or unearned revenue, right? What are you looking for on assets? Well, it's land, building, equipment, you have to kind of know those. What are you looking for on revenues? The word revenue's on it unless it's sales. What are you looking for on expenses? The word expenses on it unless it's cost of goods sold. You know these, don't you? Just relax. And equity is only contributed capital or common stock, right? Capital stock. Or retained earnings, right? Dividends are directly into equity. But that's easy. Dividends is not a cost of earning your income. It's taking some of the income and giving it to the owners, right? Once you realize that, oh, that's not an expense. Real common for students to take dividends and put them under expenses, right? That's a real common mistake. Don't do that. Because they're not an expense, right? You guys are getting closer and closer all the time, aren't you? You are for sure. Relax and think. And don't try to remember. What is it? You gotta make. And you quit calling things that say expense on them assets, okay? Yeah, don't do that. You know what's terrible is if it says prepaid expense, that is an asset.
Really?
Prepaid rent expense
yeah.
is an asset. Rent expense is an expense. Rent payable is a liability. Rent revenue is a revenue. Unearned rent revenue is a liability. Rent payable is a liability. What else did I leave out? Rent receivable is an asset. Okay, let's do that real quick. That's worthwhile. Let's use rent, and you can use any type, any account like that. Let's use rent.
Also, after rent, did we look at like the contra one again?
Sure. Okay. So what could rent be? What could all the things that rent could be? What do you got? Rent expense? Everybody agree with that? That's where I used up rent. What if that's if I'm a tenant? What if I'm the landlord? Rent revenue. Okay. What if I'm the tenant but I have not paid for it yet, but I've used it up? Debit rent expense and credit rent what? Payable. What if I'm the tenant and I pay in advance? Prepaid. True? So over I got rent expense, rent revenue, rent payable, and prepaid rent. This one's expense, of course. This one's revenue, of course. This is a liability, of course. And this is an asset. Okay, there's another liability, another asset. What would it be? Rent receivable. What does that mean? What happened? That's an asset, isn't it? What's rent receivable?
Like people owe you.
I earned it and they owe me. I debit rent receivable and credit rent revenue. I have accrued the rent. Right? In fact, this one is accruing the rent expense. This one is deferring the rent expense. This one is accruing the rent revenue. And what's the last one, you guys? Another liability. Unearned rent revenue. Yes. And what is that? I received the cash, debit cash, credit rent revenue. I am deferring recognizing the rent revenue until I earn it. And then when I earn it, what would you do? Debit unearned rent revenue and credit rent revenue. We'll come back to this, okay? We'll write all those accruals and deferrals one more time for you guys, okay? And maybe now, after you've been counting on this and thinking about it, it'll really help. I started with sort of the theory of how it works, didn't I? And all these things working, you're like, whoa. The idea of it's either a cash deal, right? Either cash now, cash later, cash in advance. That's all there is, right? If you know how to do those three things on both revenues and expenses, you can do all this stuff. That's everything. So we'll do that one more time. But you wanted to do contract accounts, okay? Equipment is the asset, or building is the asset. But as we use it up, we don't really have the building or equipment go away. So what we do is we have a contra account called accumulated depreciation. And there are going to be other ones. We're going to have accounts receivable and then an allowance for doubtful accounts on the accounts receivable. We'll get that real soon. It's another one, does the same thing. It's going to be the portion of the receivables we expect never to collect. So let's say I have 100,000 of equipment and I have 900,000 of building. I would have total of $1 million, right? But let's say I have used up 300,000 of that. This would be a credit balance in that contra account. How does it get there? I debit depreciation expense over the years, right, for different amounts that now total 300. And each year I would close depreciation expense to retain earnings, wouldn't I? The end of each year, because it's an expense account, temporary. And I would credit accumulated depreciation. What's going on here? I am increasing that accumulated depreciation account. So year after year after year, I am adding to accumulated depreciation on buildings and equipment. And maybe I put in $30,000 a year for 10 years, and it all adds up to the 300. Got the idea? That's where it came from. So what I'm saying is now my net equipment and building, in my little example here, is $1 million, less the 300 accumulated depreciation is 700,000. Got it? So what is that contra account? It's opposite the normal balance. It reflects the portion of the asset we've used up in this case. Did that? Do it.
Yeah, I got the depreciation one. It's for like the other, like the non-asset contra accounts that like I didn't understand very much.
We haven't used any of those yet, have we?
Like, I think we talked about it in class.
Oh, I mentioned that there was, well, we're going to have bonds payable, and we'll have discounts on bonds payable. We didn't issue the bond for its full face amount, and we'll have a discount with the debit balance.
Right.
All I said was there could be contra liabilities, debit balance. There could be contra equity accounts. If you use a separate dividends account instead of going straight to retained earnings, that's a contra equity account that has a debit balance. On sales, there could be sales returns and allowances and sales discounts. That would be a contra revenue account. They'd have debit balances. On expenses, you could have purchase discounts and purchase returns and allowances, which would be a contra expense account. Don't worry about it yet. There aren't very many.
It's not on the test. I'm not gonna remember it right now.
Yeah, they won't. They won't. Those won't. Accumulated depreciation won't. Okay. And we'll get into allowance for doubtful accounts soon. There aren't very many of these contra accounts. It's a handful that we use. Okay. But they're kind of handy. Right? You can show the full amount of the thing less whatever it is. In this case, accumulated depreciation. Okay. You want to do accruals and deferrals one more time?
Sure.
Why not? Okay. Now I want you guys to write these down, okay? We're going to do revenues. Let's do gardening. I always do gardening. I don't know why. Probably because, well, gardeners have a lot of supplies too, and plants and stuff that he gets his own service. So the gardener is providing service revenue, right? And then let's be young brands. They mow our lawns. Young brands actually pay people to mow their lawns. I doubt if they mow their own lawns. Oh, they might, but I bet they hire people. Young brands. KFC. Yeah. Papa. Pizza Hut. KFC, Pizza Hut. Taco Hell. Okay, anyway. So, great food. Poisonous food. Great food. Okay, anyway. You guys like Taco Bell? Yeah. It's addictive, sort of like McDonald's. Same stuff. Fat fix. Okay. And this is going to be the expense side, because they're having the work done. Okay, I want you to do cash now on both cases. Record the entry. How much should we make it for? What much should it be? Let's say that we're doing the work, having the work done for us if we're young brands, mowing the lawn. Doing the lawn mowing, right? If we're gardening company, I guess. Okay. And let's say it's for the month of May, so the grass grows. Okay. And it costs $1,000 to mow the grass. Okay. We got a lot of grass, right? At their headquarters or something. So it's $1,000 a month to mow the grass. All right. So we do cash now, cash later. And I want you to do all the journal entries associated with it. And you can go ahead and make up dates for the cash later, like when it gets paid later. Does that make sense? And then let's do cash in advance. On the cash now, there's only going to be one journal entry, right? But on the cash later and the cash in advance, there'll be two journal entries for each. True? Because you got to record the revenue or expense, and then you got to record the cash too. They're at different times. See how fast you can do that. cash later, they earn it in May, or you incur the expense in May and it gets paid later.
$1,000 or
Always $1,000. I'll even give you days. This is May 31st. This is May 31st, and you're done. This one is May 31st recorded, expense or revenue. And let's make it due June 10th, okay? We give them 10 days to pay. Okay? And cash in advance, let's say we get paid April 20th, and we earn it in May. So putting them in order, that makes sense. See where you get it. Can you do all those for me? Yes, got it. That's a yes, a yes. Close. Yes. Is it easy? Okay, let's do May 31st. If I did the work this month and they pay me this month, what did they give me? Debit cash. What do I have? Why did they give me the cash? Because I earned it. What do I call that?
Gardening revenue.
Gardening revenue. Gardening service revenue. Fantastic. On the other side of the deal, on Young Brands, they mowed the lawn. It's immediately starting to grow. I used it up. What do you call that? Gardening expense. receivable if they promise to pay me later, right? Okay, what would I have on the other side with cash later? I used it up, so I have gardening expense, just like in the cash transaction, right? If you used it up, you used it up. What is it? Because I haven't paid for it later. Gardening payable or account payable, right? Whatever you want to call it. Okay, then what happens is it gets paid on June 10th. What do they pay us with if we're the gardening company? Cash. You debit cash, don't you? What don't you have anymore? Account receivable. Fantastic, right? We're done. These two, accounts receivable canceled out, and all that's left is debit cash, credit, gardening revenue, huh? Just like it's been a cash deal. But I do financial statements in between. When I do the financial statement, I want to show the account receivable, not cash, on the balance sheet. But I do want to show the gardening revenue on the income statement and more net income and more equity on my balance sheet, don't I? And then the next month in June, I don't want the receivable anymore. I want the cash on my balance sheet because that's what I have. Just telling the truth. Okay, what happens on June 10th with the cash later? We pay for it. What goes away because we paid for it? Accounts payable debit. Oh, and what do we pay it with? Cash. And look at this. That account payable cancels, doesn't it? What's left? Debit, gardening expense, and credit cash. That's what happened. But I want to do a financial statement in between. So what do I show on my financial statement? The 1,000 expense, less income by 1,000, less equity by 1,000, but more liability by 1,000. The next month, the liability's gone and the cash is gone. So I reflect it on my balance sheet. Got it. This is working, isn't it? Okay? It takes a while to get your head around this, but once you do, all this works, right? You just keep going with it. All right. So cash in advance. What happened on April 20th? I guess I got cash, huh? Debit cash. Have I earned the revenue yet? No, so I won't record the revenue. What do I record? Unearned gardening revenue. I love it. Okay. Which is a what? Liability. And then on May 31st, I've done the work, so what do I do? Get rid of the unearned gardening revenue. Yeah. I tried to do an R too. Yeah. Okay, that happens all the time on quizzes. People will give me my examples. Yeah. Unearned gardening revenue, right? It's gone, isn't it? Because it's been paid off, right? And what did I give up? Or, I'm sorry, what did I earn? Yeah, gardening revenue. Gardening service revenue. You got it. Fantastic. And these two, of course, canceled, didn't they? What we have left is debit, cash, credit, gardening revenue, because that's what happened. It's just in 2 different months. But I'm going to do a financial statement, aren't I? At the end of April. And on that financial statement, I'll show more cash, my balance sheet, and more unearned revenue. By 1,000, because that's the truth. And then the next month, at May 31st, I no longer have the unearned revenue, but I do have more gardening revenue, and I have more equity, right? Okay, let's do the last one. Cash in advance here. I'm paying out the cash, aren't I? So I credit cash. What do I debit? I haven't used it up yet, so I have a prepaid gardening, right? Prepaid gardening expense. Prepaid gardening expense. Okay, and then what happens when I use it up? I no longer have the prepaid. So I credit it. It's an asset I have left. So what do I debit? Gardening expense. The same gardening expense that we have up here, right? Because that's what happened. The prepaid cancels, doesn't it? And of course, I'm doing a financial statement at April 30th, so I want to show the prepaid instead of cash on my books, right? On my financial statement, balance sheet, because that's the truth. And then later, I want to have more expense, less income, less equity, right? And I have less asset prepaid. If you can do all those, you're in really good shape. Tell me which are accruals and which are deferrals. These are cash transactions. I'll do the hard part. Cash later is a what? That's an accrual. This is an accrual, and it's an accrual for the expense, and it's also an accrual for the revenue. Expense here, revenue, there it is. Okay? It's true, isn't it? I accrued the revenue even though I haven't gotten paid yet. I accrued the expense even though I didn't pay for it yet.
So like, as a general rule, if cash is received or paid later, it is an accrual.
Yes. Whoa. Yes. If you borrowed, if you have an expense and you're not going to pay for it yet, you're accruing the expense. If you have a revenue and you earned a revenue but you haven't been paid yet, yes, you're accruing a revenue. Now, if you get paid, though, and you haven't earned it yet, that's cash in advance. What's that? I'm going to defer so easy to switch around because we want it to be the cash instead of the revenue or expense, don't we? That's what gets us, okay? All right, and on this one, what is it? Same thing. I paid for it in advance. I am deferring recognizing the expense until I use it up later. This is also a deferral. This was worth an hour and 45 minutes of your life. Huh? Really pay off. Study, 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 study. As many hours as you can put in. Get it solid, right? Just think of every minute that you study now, you don't have to study for the final. It's just true. Right? The only way I can keep myself exercised is I believe that every hour I exercise gets added to the other end of my life. Probably true. If I had never exercised in my life, I'd weigh 400 pounds now and I wouldn't be alive. See, look at it that way. So it's probably getting added. Keeps going. Okay. Of course, I could quit.